everybody. It's Jack from Jack Gately Real Estate and the Online Real Estate Academy. Wow, what Powell said yesterday. I think we have a couple of important takeaways and some important data points to look out for. Number one out of, I think, 4 major points as I was taking notes yesterday during the desperately long Powell press conference and statement yesterday at 2:30 yesterday afternoon. I watched, so you didn't have to. Trust me, it was boring. And so I'm going to boil it down to the 4 most important things. I'm going to take a look at what the markets did after that, which is, heading higher. We'll just say, summarize now, tease that now, and we'll look at some data on that in a minute. First, the number one thing that stuck out in what he said yesterday in his statement is that the full effect of the 5+ points in interest rates that they have raised since early of last year has yet to go into full effect. In other words, the recession that they're trying to cause hasn't happened yet. But I don't know about you, but if you've got your pulse on the economy, I'm noticing a couple of things slowing down in the economy, just a touch. Some warning signs, as I've mentioned earlier. The second thing that he said that I thought was very important is that we had a long way to go to 2%. And this is an acknowledgement that we're nowhere near the so-called 2% goal of the Fed to hit for inflation. Nowhere near that. We're way higher than that on both CPI and core CPI. In fact, headline CPI went up last month, so they're nowhere near that. They obviously announced a pause, no action, and yesterday there wasn't a hike, there wasn't a cut, but there was an indication that there would be another hike this calendar year. His language on this so-called soft landing was less than optimistic, and it reminded me of his quote from the Jackson Hole conference, a couple weeks ago, where he said that we're navigating by the stars under a cloudy sky, which was also not very confident. But effectively, he said that a soft landing was plausible. That's not it's not very confident. It means there's several other opportunities for a worse outcome. I actually made a video about that, and Larry Summers, who was highlighted in that video, said, effectively we have the no landing, which is higher for longer. We have the hard landing, and then we have the combination of all 3 of those, which is also known as stagflation, which is the worst of all outcomes, pending a Great Depression, I guess. And then one thing that really caught my eye was that the last of the 4 points, I think, is that he said that there are factors outside his control, outside of the control of the Federal Reserve, which would, how do I want to say this, prevent them from achieving the 2% inflation goal. And that was very concerning because effectively the way I read about that is what he's saying is congressional spending, government spending, right? Because there's basically 2 levers on the economy. One is the Fed and their control of the money supply and interest rates. And the other one is, of course, how much the federal government is spending, and Powell has no control over that. And we are spending like drunken sailors. I saw this on the internet. I think at least drunken sailors, it's over in the next morning, so to speak. But no, our federal government spending has been drunk for decades. And it is really getting to the point where our debt service is beyond scary at this point. Let's take a look at what the market did. Let's take a look, as always, the 10-year Treasury. See if we zoom that up there for you. No, we can't zoom it. This is where it's got to be. Okay. 10-year Treasury, 4.474 as of this morning at approximately, 9:15 a.m., as the market is just about to open. You might remember that I just did a video the other day about how the resistance was 4.34. Now we're at 4.474. We are going up. It is up, up and away, and not so of a beautiful balloon. Interest rates usually follow this. There's a differential of about 300 basis points, but, you know, the mortgage rates follow the 10-year note more or less, and the 10-year note is up. Yesterday, according to Mortgage News Daily, the 30-year fixed was at 7.33, and so we are creeping up again, closer to the 7.5 that we had in August. So Lance Lambert, who is one of the most notable Twitter voices, noticed that the bond market is cooking. The 10-year Treasury just smacked the highest level since 2007. The 10-year Treasury just smacked the highest level since 2007. And apparently that was not a glitch, because he wrote this tweet last night, and again, and it's, you know, it's holding true. It's actually higher than it was when he wrote this tweet. That is not good if you want mortgage rates to decline. If you want mortgage rates to decline, that's probably not going to happen, because the 10-year Treasury just went to the highest level since 2007, and effectively since the last couple of years, more or less the trend has been straight up. This means that highly likely we are going to be looking at higher interest rates. Not only higher for longer, or high for longer. You know, again, the conventional wisdom is it could never go above 7.5%. You read that. Everyone is saying, every article out there is tilted that this is the max. I don't think so. And just look at the chart. You know, it's just not the way it looks. Now, one thing that I thought that Mortgage News Daily brought up in an excellent article from them. Let's see if we can pick that up on my page here. Here it is here. Higher for longer, written yesterday afternoon. Today, the Fed announced was largely expected. No rate hike yesterday. And higher for longer communicated via the dots. So believe it or not, there's this thing called the dot plot, where the Fed members, their opinions on the economy are actually put on a graph like dots. The direction of the change in the dot plot is no surprise, but the magnitude was. In other words, the expectations of the Fed members is that interest rates are going to be higher for longer. But what also changed is that they expect it to be higher for longer, if that makes any sense. Let's go back to the article. The median Fed member moved their forecast up by 0.5% for both 2024 and 2025. Granted, those forecasts have a poor track record of predicting the future, but the Feds speak to the Fed's will to continue hiking if the data remains resilient. What basically this dot plot means is that the Fed members are less optimistic that they will cause a recession, and therefore they are stating that they are willing to raise rates again in 2024 and 2025 if need be. Now, they seem to be thoroughly committed to a rate hike later this year in 2023, one more rate hike in 2023, and their expectations of where interest rates will go for 2024 are now elevated. Yeah, that's not good news if you think that you're going to get a 7.5% mortgage today, or 7.2 or whatever it is right now, 7.33, and then refinance next year at 5.5. I don't think so. Getting back to the Mortgage News Daily. Bonds held their ground reasonably well at first, but late-day positioning squaring resulted in a break to new long-term yield highs, which is what we discovered, well above the 4.34 that we had been watching. That level has now been eclipsed, as right now, as we watch this morning, we are at 4.478. Yeah, it's just going to the moon right there. Not a good look. We had some other data that came out. I want to cover this for you fairly quickly. That came out over the last couple of days. First off, the home builder index dropped to I think it was a 3-year low. 3-year low is expected to be 49.5. It dropped to 45. That's a lot. That's a big drop. Again, this is all a ripple through because of interest rates. There was this theme out there that this is only affecting the smaller builders. I think smaller builders tend to be lesser capitalized, but it's affecting all the builders, I think. Housing starts, which did not get a lot of news, but housing starts fell. It was expected to be 1.43. It came in at 1.28. That is a huge difference. Housing starts. That means that they're actually starting to build the house. They're swinging the hammers. They're pouring the concrete. That means that effectively builders might be green-lit to build the building, but they're holding off. They're holding off because they probably see that these interest rates are spooking buyers, right? Permits, however, were up. Permits actually exceeded expectations for whatever reason. Permits were 1.45, and they came in hot at 1.54. So they exceeded quite a bit. But a permit is a lot different than a housing start. I think that's a very important distinction. A housing start is, we're swinging hammers, we're cutting wood, we're putting up shingles. That's real economic activity. A permit is just simply when we went down to the town or the city hall and filed a piece of paper. It's effectively meaningless. It's obviously you need it to start building, but it doesn't mean that you're gonna build. All right, today, later this morning, we're going to bring in existing home sales, which are expected at 4.1 million. I don't know if we're going to meet that number. There is, one rental at a time. He's been talking about today's data point. Mike Zuber, he's a great YouTuber. He's been talking about this data point here for a long time. And I'm going to be very interested come later this morning whether or not this goes under 4 million, because he's been predicting it will go under 4 million for a long time. So we're gonna Zuber is going to be fact checked in about a half an hour when this existing home sales report comes out. We will keep you posted. As always, I'm Jack from Jack Gately Real Estate and the Online Real Estate Academy. Thanks for watching.